we can very clearly see that gold right here was into some support. That crazy candle, topping tail, whatever you want to call it, fell right back into support. We had lots of converging support right here. And again, we've gotten a bounce off that. The first step for gold, guys, this is the first step for gold, is to close above this level. Basically $2,080. Now you might say, well, what about this? Well, that's secondary, right? That's a secondary level up there. But so far, we have not had a daily close above this line that goes back multiple years, 3-4 years to the 2020 highs, right? We have not had a close above 2080. That's step number one. Then after that, once you achieve that goal, then you start analyzing and seeing if you can break above the high, which was around 2150 or so. Again, I've calculated out my inverse head and shoulders target should be around 2,500 and change in 2024. I do believe it'll happen in 2024, but needless to say, longer-term projections, they're never as accurate as shorter-term projections. You know, just like this. This was a projection right here, right? Very easy, right? I mean, it's not easy, but the point is you see the results right away, and it's right into support, versus when you're going out long, you're dealing with a lot of unknowns. You don't know what central banks are going to do. You don't know what this is going to happen. You know, what's this and that and everything like that. Okay, a couple other things I want to just quickly go over here. Bitcoin, obviously. Now, Bitcoin had an interesting little intraday dump just a little while ago. It has recovered, but I do think that we have to be aware that Bitcoin continues to be something that is very, very volatile on an intraday basis. There have been periods where Bitcoin calms down, but again, we've been seeing more and more of this kind of whippy volatility where Bitcoin was trading at 43,300 and it dumped to 41,500 about. I mean, that's a very big dump in about 30 minutes of time on the 10-minute chart. Now, if we flip over to the daily, however, the daily doesn't look quite as crazy, right? If we look at the daily here, it's been up. It kind of had this, and I love some of the comments I saw you guys really appreciating the analysis on what a bear flag is or an immature bear flag, stuff like that. But again, this was a bullish pattern which failed. Then you started to get sideways consolidation, but you never got a mature. I mean, it was really just one candle yesterday and then the beginnings, and then we popped up. So when you look at this chart, to me, this is kind of like what you'd equate to a 50-50 at this point. And what I mean 50-50 is that essentially what you're getting now is you're getting sort of a wedge pattern. And the question is, well, which way does it break? Does it break this way and go here, or does it break this way and tackle the highs and then eventually go to that 48 to 50,000 level we've talked about on the chart? So again, now that we don't have any firm pattern formations, you just have to sit back and kind of say, okay, well, which way does it ultimately break?
What's up, Crypto Street investors? We've got an SEC showdown in the Bitcoin HF realm. This SEC is throwing down the cash gauntlet, but BlackRock's not backing down. Subscribe, hit like, and let's dive into the clash of the crypto titans. Crypto wizards at JP Morgan are shaking things up. While staying cautious about crypto, they're shouting from the rooftops that Ethereum's gonna outshine Bitcoin and the whole crypto crew by 2024. Talk about a plot twist in the crypto saga. JP Morgan's analyst dream team, led by Nikolaos Panagiotou, predicts Ethereum flexing its muscles and regaining market share. What's the secret sauce? It's the EIP 4844 upgrade, also known as proto-dank sharding, set to kick in by the first half of 2024. This upgrade's like Ethereum's superhero cape, major improvements inbound. What's this dank sharding magic, you ask? It's a slicker way of sharding for Ethereum, making it more efficient. And JP Morgan's not holding back. They're throwing $35,000 on the Ethereum price tag by riding the proto-dank sharding wave. Move over Bitcoin, Ethereum's the new crypto superhero in town. Breaking the crypto mold, Borrow Finance is the new kid on the block, armed with AI superpowers. Bitcoin and Solana had their time in the spotlight, but Borrow's turning heads by blending AI with blockchain tech. It's like crypto evolution in action. Borrow Finance's pre-sale is breaking records. Over $1.8 million raised and 170 million rows sold. That's not just confidence, that's a crypto stampede towards Borrow. Is this the smart move for diversification? The crypto community is buzzing. The SEC's got a plan. They're demanding a cash redemption model for Bitcoin ETFs. Invesco and Galaxy are bending the knee, updating their filings to go the cash route. But wait, what's the fuss about cash versus in-kind? There are two ways ETFs create and redeem shares, cash or in-kind. Cash is like a direct transaction, while in-kind involves a basket of securities. It's a battle between efficiency and flexibility, But the SEC seems set on the cash create ETFs, wider spreads but more flexibility. The drama unfolds. BlackRock's playing the long game, pitching an in-kind model to the SEC. But Bloomberg's Eric Balchunas drops the bomb. The SEC might be digging in its heels for cash creations. Will BlackRock bend the knee? The crypto world holds its breath. Now let's continue our enlightening discussion with Gareth Soloway.
Obviously, the Federal Reserve came out yesterday, and Jerome Powell was basically as dovish as he has ever been. He talked about 3 rate cuts next year. Now, what's amazing about this is that as soon as he said 3 rate cuts, the market said, no. We're going to price in 6 rate cuts. So a whole, basically 150 basis point in rate cuts next year. Now, remember that just prior, I was telling you in these game plans that it was already at 130 basis points in terms of rate cuts next year. So the markets are even going far and beyond what Jerome Powell is saying. They're just taking his cue of being able to talk about maybe cutting rates as something to really rip higher on. And oh man, did the markets rip. Unbelievable. We talked about that channel that we were in the S&P. Now, for the last really month, we blew right through that to the upside. Now, in the backdrop here, what we have is the chart of the 10-year yield. Now, remember, we had come down right around this support area and gotten a little bit of a bounce. Yesterday, huge flush in the 10-year yield. Today, it is continuing lower. Now, the important thing about today, folks, is we have to watch, do we close below this trend line low right here? If we do, and if we confirm tomorrow, you now open the door to seeing further downside. And I'm going to show you where your next target would be on this. And again, you got to actually zoom out a fair amount on this chart. But basically what we can do here is we can take a line going all the way back to kind of the low area here and drag that up. And that would be a potential level there. And what's kind of cool about this, and I'm going to show you guys this, this is some really cool stuff. Look at the channel that is developed here. Okay, so again, what we see here is we look at this area down in this corner. We start there, and this is when basically interest rates were near zero, right? We connected through all of this low area and this low area and even this low. And that line takes us up to about 2.96%, essentially 3%. You then look and extend that parallel, and it coordinates perfectly with this high and this high right there. So what I'm going to tell you guys is this, is that I don't think we're going straight down here. I think by the way, if that happened, the economy would be in shambles, and we're not seeing that. But I do think, again, a break of this area takes us out of a potential level that at least takes us down, maybe down to this area here around 3.5% would be that next stop. All right, so again, around 3.5%. Ultimately, though, 3% is on the table based on that bigger channel that we're seeing. Now, this morning, which is interesting, right? So we had a unbelievably dovish, at least dovish compared to what the markets were expecting Jerome Powell yesterday. Now, again, one of the interesting things today, we got jobless claims. Jobless claims came in 19,000 lower than expectations, or basically 19,000 lower than last week. That means less people filing for unemployment, meaning a stronger economy. We saw retail sales today. Retail sales were much stronger as well. So it's so interesting here how Jerome Powell yesterday comes out and says something like, oh, well, we're talking about rate cuts next year if inflation continues to come down. But the economy, that today at least, we're seeing it still strong economically. People are still spending, and we're still seeing not that much on the employment side breaking in this range. All right, so that was today's action there. I do want to flip on over here and talk a little bit about the U.S. dollar chart as well, because we have a big breakdown on the U.S. dollar. So, I mean, literally, and by the way, folks, I'm going to be fair and frank with you guys. Part of me thinks a couple things. You can't help but say, is this attempt to lower rates and bring things back in check, even though CPI, Consumer Price Index, inflation is still between 3 and 3.5%. So we're well above what the Fed has talked about at 2%. But you have to wonder, is part of this election type stuff? Are they trying to just bring it back in to not crash the economy in 2024 going into the elections? Or Is it something to do with the U.S. debt where they're starting to realize? Because one thing I've noticed, have you guys noticed how Janet Yellen's been out there talking up a storm? She's been everywhere talking about, oh, everything's good, and it's almost like there's two Fed presidents right now, two Fed chairs, I should say. And you have to say, if the U.S. debt is at $34 trillion and interest rates were to stay where they were, this country literally would be bankrupt much, much faster. And that's arguably saying, is it even already bankrupt? So these are the things that kind of go through my head when I see these kind of weird scenarios. Like what Jerome Powell said yesterday was out of left field, in my opinion, based on the data that we're seeing, based on inflation still being north of 3%. It's not even like we're in the 2.5 to 3 range. We're well above that 3% range. And so something's not computing here. And that's, again, something we have to figure out. I think it's something that eventually the markets will get skittish on. But right now, and I've said this in every game plan, the only thing the markets care about is the dollar falling and our yields falling.
That wraps up today's crypto news highlights. Stay tuned for more updates, insights, and analysis from the world of cryptocurrencies. Please share your thoughts in the comments below. Don't forget to like this video and subscribe to our channel for more engaging content.